There's never a bad time to speak to Pinakin, Parikh, but this is as good a time as any to talk to him, or in fact, a really opportune time to talk to him, considering the fact that we are at a point of time wherein the opinions around whether the super cycle or the cycle in commodities would continue for longer, or whether it is reaching a peak, that argument has hit a crescendo, so to say. They were amongst the first ones, JPMorgan, that is, to turn and remain consistently bullish on all things commodities, but largely oil and gas and metals. And it'll be very interesting to see if there is a dichotomy out there currently, whether he still remains bullish or is he now starting to turn a bit neutral, considering the impact on demand that could come about because of such high prices. Pinakin, great having you. Thanks for joining in. Hope all is well.
All well, Neeraj. Thank you for having me on your show.
The pleasure is ours. So, Pinakin, really, that's the talking point today. Can I ask you if you continue to remain bullish on commodities and commodity-linked names, or is your
Uh,
view now slightly different than what it has been?
sure, Neeraj. So JP Morgan at a global level, right, across global equity strategy, regional strategist, commodities remains our top sector. In fact, the JP Morgan global strategist came out with an interesting report last week where they said the highest conviction sector is the energy sector. So yes, we are entering a period of volatility, but I don't think we are done with the commodity cycle, which now will enter its third year after COVID. So we remain positive on commodities and commodity equities.
Okay. Let me first start with energy, since you've stoked that. Uh, I think multiple people use that term now that maybe this decade, oil is indeed the new data, if data was the new oil in the last decade. At the same time, I hear uh, enough number of people, Pinakin, talk about the conundrum that companies would be in that if, for example, if a Shell wants to lay out newer investments to expand capacities, it'll run into this whole ESG argument as well. So therefore, does this last for longer? Does it carry more investments, or would it largely be earnings led, which could come off as the commodity demand comes off? Is always that main argument. You must be facing this argument as well. How do you approach this when you are thinking through your construct?
Sure. So let's take a step back and let's look at energy in general and oil in particular. So the JP Morgan Global Energy team actually did a very, very good research report on the oil super cycle. This was done pre-COVID. Obviously, prices tanked. But the fundamental construct in oil has been that we have had a decade of underinvestment, and oil demand is going to continue to grow by at least 1 million barrels per year for the next 10 years or so. And you have production growth, which will struggle. And even on the ground, OPEC is struggling to bring in 400,000 barrels of oil per month that they have been talking about. So what you have is that barring massive investment in oil, capex, you are going to have deficits which are here to stay for the next few years or so. Our long-term oil price forecast is now at $80 a barrel. So what you have is that the commodity market is very delicately poised. You have, even with a steady state demand growth, supply which is not able to catch up. Equities, on the other hand, and this is not about Indian equities, if you look at global E&P equities, they are discounting an oil price of roughly $60 to $65 a barrel. So investors remain bearish on whether oil prices are sustainable. They worry about demand destruction. They worry about potential ESG issues. But what you have is, so far, we have not seen demand destruction. And even demand destruction would essentially balance oil markets temporarily, simply because of the supply deficits you have. And on ESG, what we are clearly seeing, and this is when we have spoken with so many investors, is that there is a dialing down of the ESG discount across the commodity space. Various macro factors have obviously helped, but investors are not as averse to owning commodity equities, oil equities today as they were 2 years back. So my sense is that, you could be in for higher for longer prices across commodities in general and oil in particular.
Okay, I'm sticking to oil for a moment, Pinakin, and then we'll move on to the others as well. And oil and gas, trying to bring in upstream into the conversation here. We know that presumably the earnings momentum can be strong because of simply because of the higher APM gas prices and the higher average crude realizations, presumably. But production for Indian companies has always been a bit of a soft spot, at least to my understanding, and please correct me if I'm wrong. Do you reckon that as the year moves ahead and as higher earnings start to flow in, and I want to understand if you believe higher earnings will flow in, of course, but if the hypothesis that they do you think the investor appetite for Indian upstream companies as well could meaningfully change from what it has been thus far? They've rallied a bit, but not quite in the same vein as maybe the metals did.
Sure. So, I mean, over here, we also, so first of all, stock performance, right? So this is the common complaint we get, that Indian upstream stocks have not rallied. Interestingly, if you were to pull up a screen of global E&P companies, the Indian ones have actually been among the top decile performers on a YTD basis, on a 1 year basis. What you have is globally E&P stocks have not done as well as global metal stocks have done. And this is for a variety of reasons, ESG issues, unsustainability of oil price, belief. So it is not that Indian E&P stocks have done very badly. Now, going forward, if you have regulatory certainty stay, and which is what our view is, that it should stay, we should have policy visibility and clarity, earnings will flow through. And for the Indian sector, right, higher earnings translates into higher dividends. Our sense is that the stock prices, even without a multiple re-rating, should at least track the equity consensus earnings changes, because consensus earnings across the board in India is pricing in far lower realizations and prices compared to where spot prices are. So as long as spot prices sustain at current levels, you should have stock prices track earnings upgrades, consensus earnings upgrades.
I presume that your earnings estimates, Pinakin, are higher and than what the street estimates are, because I've seen your reports. You've consistently been kind of more
Sure.
bullish.
So our earnings estimates across the commodity stocks we cover is higher than the street. Having said this, they also build in a big discount versus spot prices. So essentially, we see the cycle continue of the last 2 years, where the markets keep on getting surprised in terms of how sustainable these commodity prices are.
Got it. But again, an offshoot onto energy, from oil into something else on energy. I would love to understand from you, how do you see the landscape evolving over the next 5 years with the multiple other sources of energy being spoken about? I mean, while ethanol does what it does, green hydrogen right in the fray, and other factors coming into play. And are there many direct ways in which you can play it via the listed space, or would people necessarily need to go into indirect or unlisted place to do this?
At least, so when you look at the commodity basket, right, most of the commodity companies are sticking to what they do, which is stay in the energy business, upstream business. And you do not have that many companies going and pouring into the non-fossil fuel energy businesses. So I guess as an investor, you would have to look beyond the commodity space in most parts, barring one or two names. And at least at this point of time, we do not come across as many listed names who are going in a big way in these non-fossil fuel energy sources.
Okay. Pinakin, is there anything else that we should talk about on the energy side before we move on to the other commodities? Have I missed out on anything per se?
No, you have covered everything.
Most of the things. Okay, great. Though I'm sure I could continue to make another half an hour conversation with you on this, but okay, fair point. So thank you for that. Now let's shift focus to metals. Pinakin,
Sure.
the argument that I hear now, I have started to hear over the last 20, 30 sessions, if you will, is that at some point of time, this very, very high commodity prices would abate a bit, and if not normalization because of hopefully the conflict ending, then just the demand destruction that comes about because of such high prices would lead to
Sure.
maybe some bit of a cool off in these. What is your thought here?
So a couple of things, right? If you strip out the last 3 months, which is Feb, March, and April, commodity prices were at an all-time high when we entered Jan and Feb. Since then, they went up, metals prices went up another 20-30%. Now, at this point, at least across the basket, we have not yet seen any material demand destruction. Now, demand destruction is going to be an evolving process. It is not going to be specific to a particular metal. It is broadly on the economy. At what point do global economies start facing demand destruction when commodity prices keep on moving higher? At least we are not seeing signs at this point. So yes, there could be another leg higher and we could eventually see demand destruction. But the point is that if, let's say, metal prices correct 10% or 20% or whatever number you want to call it, if you go back to where prices were in, let's say, 3 or 4 months back, there would still be at decadal high prices. This will still be prices at which the companies would be extremely profitable. So what is interesting is that the investor discussion has moved from a collapse in metal prices to a correction in metal prices. So now nobody is talking about metal prices going back to, let's say, 2017-18 levels. January is what people are talking about, which in our view is a healthy correction. It is not a collapse. I think we still have the fundamental construct in metals as is in energy, which is that China's decarbonization supports lower supply, even as demand growth should remain robust, especially if the world is going to do as much renewable spending as expected.
Yeah. So in fact, I was going to ask you that. So in the classic conflict between very high prices leading to some bit of demand destruction temporarily versus the expectations of a capex super cycle of sorts at some point of time starting, and back home in India, most certainly starting at some point of time in maybe early 2023 or maybe even late 2022, what does it do to companies in India which are where I believe and I believe metal prices are anyways at a discount in Asia compared to what's happening in the Western world as well. So lay out this construct for us, lay out this piece for us, and how are you thinking about what the prices behavior could be?
Sure. So generally what happens is if you go back to the period of 2004 through 2012-13, when India had a very robust capex cycle, domestic prices would be at a premium to import parity prices, especially in steel and even the other metals as well. Over the last few years, we have moved to a parity or a discount simply because domestic demand has not been as strong. Now, if we are going to enter a capex cycle in India, in fact, all the large corporates are laying out large capex programs for execution. At some point of time, that spending on the ground should pick up, and you don't have much supply of metals. In that environment, there is a very clear possibility that we can mean revert back to a premium over imported prices, especially in things like steel. And that would obviously be very positive for the domestic companies, the domestic Indian manufacturers, because effectively they get a premium and they need to be incentivized to add more capacity. So if you have a construct where global supply coming out of China is limited, global demand is steady, India sees a capex cycle, then you have a confluence of positives, which is global prices remain steady and India domestic premiums rise. So it's a sweet spot for the Indian metal companies.
So the lay belief is that it is a cycle and the cycle will come off. What I'm trying to, what I believe I'm listening to you and you are trying to imply is that yes, it may come off, but for now we seem to be in the middle of the up cycle and not necessarily towards the peak.
Sure. And the other thing I would lay out is, the definition of this cycle. Historically, take steel, for example. Since the global financial crisis of 2009 through 2020, for 11 years, steel prices were in a $250 to $600 range. Prices would bottom out at $250 and prices would peak out at $600. Now, when you look at the last 2.5 years, you have had steel prices in a $700 to $1,200 range. And in fact, when you go back to the fourth quarter of last calendar year, October to December period, when Chinese demand was severely negative, as negative as it can be, steel prices bottomed out at $850 a ton. So what you have is that the peak and troughs, or the cycle itself, has moved structurally higher. So I don't think we are going to see anytime soon prices go back to, let's say, what they used to be the cyclical lows of the previous decade or so.
On the contrary, can this, in your assessment, is there a possibility that this band could structurally move even higher from where it is right now, or is that too difficult a call to make?
So a lot depends in the near term on China. So if you look at the metals global markets, right, it has been a supply-driven upcycle for the last 12 months or so. Demand out of China has been very, very weak, and while there were expectations of a pickup, obviously the COVID lockdowns has impacted demand. Now there is a lot of talk and expectations about some kind of infra pickup, quote unquote infra stimulus coming through once the lockdowns are lifted. If you enter the second half of the year where the global supply remains as tight, and you have on the margin also a China-led demand boom, or demand recovery, then yes, versus market expectations, you could actually have metal prices and steel prices even move higher in the second half of the year.
Mm. Okay. What about the non-steel or the non-ferrous category? And I would love to understand where is it that you are constructive, where is it that you are circumspect? Because again, I see conflicting notes coming in on what could happen to zinc, what could happen to aluminum, and how it would thereby impact some of the listed stocks. So without getting into stocks, of course, but what's your
Sure.
thought on the non-ferrous side?
Sure. So what has happened in non-ferrous is obviously prices have rallied much more than steel. And I think the fundamental difference is that steel is a traded commodity, while non-ferrous is an exchange traded commodity. What it means is that the investors could express a view in non-ferrous versus steel, and which is why non-ferrous rallied much harder than steel did. And with the risk-off sentiment that we have seen recently, non-ferrous has also pulled back. Aluminum prices are down 15% versus, let's say, steel prices being up. The fundamental supply demand still remains as tight in non-ferrous as it is in steel. So having said this, on a fundamental basis, we don't see aluminum or zinc, at least for the next few quarters, being loose in terms of market balances. Having said this, those base metal prices will be more influenced by risk on or risk off behavior by investors who can directly participate in those commodities. Secondly, any demand recovery in China in the second half of the year from a pickup in spending would be more positive for steel and ferrous than it is for base metals. And the reason being that China is in a deficit in steel and ferrous, and therefore when Chinese demand goes up, iron ore prices go up, steel prices go up. So fundamentally, I think ferrous has a better outlook over the next couple of quarters than base metals have. But I think the underlying supply-demand balances remain tight in both the sectors.
Okay, my final question to you, Pinakin, before I let you go. We've spoken about China at length and the impact thereof, rightly so. What about Europe? And what I mean by that is that if when the conflict ends, not if, one certainly hopes it ends sooner, but when the conflict ends, some of the smelters, some of the production facilities which might have been impacted by supplies or by the location restart. But at the same time, the demand, because of rebuilding Ukraine, so to say, might also come in as well. So how would the push and pull factors work out to your mind?
Sure. So I think the fundamental question that we have to answer is that would a de-escalation lead to a normalization?
Right.
What we are trying to say is that if tomorrow, for example, whatever happens on the conflict, would commodity supplies go back to where they were as of January? And the JPMorgan global team believes that a certain amount of energy supplies in Europe would have to be diverted over the coming years, whether it's oil, whether it's gas. And what it means is that higher costs, higher energy costs, especially for Europe, would remain. Now, whether we have $120 oil or $150 or $90, I think that's something we have to wait and see. But clearly, energy costs are not going to come off. What that means is that if you're a zinc smelter, if you're an aluminum smelter reliant on gas in Europe, you're still going to face higher costs. So I don't think so we are going to see a collapse in energy prices, because that is what you need in order for a lot of the shut capacity to come on stream. So I think some of the supply remains off market in the foreseeable future.
Wow. Pinakin, sorry, I'm taking my word back. I'm asking you one more question. Maybe I should have started off with that because that was front and center
Sure.
today. This whole conversation of the EU ban on Russian oil. I'm taking the conversation squarely back to energy, but I'm just asking you, this whole conversation about EU ban on Russian oil for the very near term, does it have a material impact, likely on sentiment and on oil prices, and thereby on the sentiment around the energy companies?
So it's a difficult question to answer. I mean, we would not comment anything directly on the conflict, but the JP Morgan Global Energy Strategy team, what they highlight is that we have a situation where liquidity is extremely low in the oil markets. And therefore, the market price movements on even a small dislocation in supply is very, very large. So 1 million barrels of energy supply can have a $35 price impact versus $15 to $20 what it used to be last year. So I think we will, oil should remain, very strong in the near term.
Yeah. Okay, great. Thanks, and apologies for bringing in oil yet again, but just thought there's a critical piece to answer. So thank you for that. And as always, lovely talking to you. Thank you for laying out all the pieces for us, and look forward to having more often.
Thank you. Bye.
And viewers, thanks for tuning into this edition of The Talking Point.